Hi, good morning, everyone. I apologize for the technical difficulties with getting started this morning. So with that, let me just go ahead and jump right into it. Last week, we had a strong week here to the market after the CPI report kind of cleared the way for potential further easing from the Fed in 2026. You have the combination of the softening labor market and cooling inflation that gives the Fed more room to cut rates next year. And that was what the markets needed to sort of drift higher here into the new year as we consider this a relatively seasonally favorable time of the market, where about 75% of the time we see markets move higher, or what we typically call the Santa Claus rally. Um, so right now, as we head into what is some of the thinnest liquidity of the year, we're now within spitting distance of the 6,900 S&P 500 double top or 690 double top here on SPY. I expect that with the thin markets between today, um, tomorrow, Friday, and next week, I think there's a pretty good chance that we take a crack at 6,900 and potentially break out higher from here. The question is whether or not we can hold those levels when we reopen next year on January 5th. I think that's going to be the big test for equity markets. 6,900 has been a formidable a resistance level here that's been in place since October. And the question is whether or not the markets can see its way higher above this level. If we can get above that level and hold above that level here, um, by the beginning of next year, that generates a very strong bullish signal here for the overall market. At the moment, it's really interesting to kind of see uh, that the market breadth has been incredibly strong here over the last month or so. If you look at the markets, while the S&P has struggled to get back to these all-time highs and break out, it's actually, if you look at the equal weight S&P 500 index, and you look at RSP, RSP has actually broken out to a new all-time high. And what that shows us is that the rest of the market is actually seeing a fair amount of strength here. Look at RSP. RSP recently broke out to a new all-time high, pulled back to that support level, and is now continuing to show some strength here. So market breadth has been quite strong here, and it's actually somewhat strange to some degree to see that the rest of the sectors are leading the markets higher, and it's actually tech that's holding everything back. Um, so the rotation out of tech into the rest of the sectors is, generally speaking, a healthy mechanism for the markets. You generally don't want to see just one sector leading the markets higher while everything else gets left behind. We've seen that for a long time, but the rest of the market is playing catch up. The rest of the market is actually outperforming the S&P 500 and outperforming the technology sector. And if we do see tech kind of play a little bit of catch up here, that would certainly give the S&P the momentum to break out above 690 and continue to move higher from here and create a new bullish trend here for the overall market after what has been, call it a 3-month consolidation phase. So the fact that we're seeing rotation on the retest of the breakout above 690, I think, is a generally healthy sign here for the overall market and lends more credibility and more confidence to a breakout signal above that double top level at 690. So overall, as we head into the end of 2025 and the beginning of 2026, the overall equity market looks actually fairly constructive here to um, for further upside going into the first half of 2026. If you look at the bond market HYG, you see that the bond market, the high yield corporate bond market, continues to produce kind of a risk on signal here. We continue to make higher highs and higher lows on HYG. The one thing that kind of um, concerns me a little bit here is really interest rates. Despite, the multiple rate cuts here, we continue to see bonds continue to sell off here. As you can see, the trends here for bonds have remained fairly challenged and actually look um, quite bearish here. The 10-year yield is remaining around that 4.1, 4.2 level, despite the rate cuts and the expectations for rate cuts going into the first half of 2026. That's really what I think is going to hold back equities to some degree. So there are some macro headwinds that I think we need to be aware of, and especially a cooling labor market is definitely one that we need to be conscious of, because the interest rate cutting cycle is in response to what is a cooling economy, specifically a cooling labor market. And the question is, how fast is the labor market cooling? And with the delayed government data, we're not getting a full complete picture yet. We're getting a much more delayed response. And I think that's kind of one of the things that it's been holding back the equity markets from really breaking out more confidently and um, more confidently. And that is really the big, I would say, macro data piece that I think is important for investors to keep a very close eye on to better understand whether or not the Fed has cut interest rates deep enough to sort of offset the cooling of the labor market. And we really need to see the labor market stabilize a little bit more. And hopefully that October data showed that there is a little bit of stabilization. And we're really looking for more of that in November and December to confirm that. Otherwise, a further cooling of the labor market requires more rate cuts just to kind of keep things neutral. So I think that the labor market is going to be an important part or an important component to be aware of heading into the beginning of next year to kind of to drive the overall sentiment here for the equity markets. But overall, corporate profits continue to rise. We're seeing corporate profits rise at a level that um, uh, supports the rally that we're seeing here in equities, supports a potential breakout here in equities, as long as the labor market and the Fed can kind of maintain a more neutral or stable economy here in the US. So, at a macro level, that's really kind of what we're looking at. If the S&P 500 can hold the 6,800 level, which it has, the Santa Claus rally, generally speaking, will likely drift this markets to new all-time highs by the beginning of next year. And we're looking for that to be confirmed, when markets opened up in January 5th after New Year's Day, and hold those levels to have that bullish view here for equities again. So, at a very high level, that's where we stand from a macro perspective. I don't necessarily know that we need to go too deep into individual trade ideas just because, we are heading into some of the thinnest trading days over the next couple of weeks. And generally speaking, I don't necessarily advocate adding a lot of additional exposure here over the next couple of weeks, but really spending more of the time monitoring your existing positions, making sure that you are um, taking a close look at kind of your risk positions and making sure that if you need to cut losses, if they reach certain thresholds, look at adjusting profitable positions. But we generally don't advocate adding a lot of new exposure here in the next couple of weeks. So we will be taking a week off from our Tuesday market outlook sessions next week. and we will be resuming again here on January 6th. And that's where I'll be able to provide you with my next macro update. And at that stage, we'll be back to more normal markets from a volume perspective and be able to give you a better understanding of where we currently stand after these 2 weeks. So with that, that covers what I wanted to share with you here today. I hope everyone here has a happy and safe and prosperous holidays with your family. I hope wish you guys a happy new year, and I look forward to reconnecting with you guys here on January 6th on our next Tuesday market outlook session. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next time in about 2 weeks' time.